English language, of course, is the word hello. A popular word in a business environment is check and close. The three most important words in investing are margin or safety. And here to discuss appropriately now, I have three of the best minds in value investing: Sanjoy, Bhattacharyya, Raamdeo, Agrawal, and of course Anoop, Bhaskar from BTI. Sanjoy, let me start with you first off. When was the first time you introduced to this concept called margin of safety? When did you stumble upon it? When was your eureka moment?
Late 80s.
And how long were you in the investing career at that time?
About a year.
Just about a year?
No, actually a couple of years. About a couple of years, because I really got seriously interested in investing only in 87, early 87. So I'd say a couple of years.
So you went to IIM, no one taught you margin of safety?
In fact, I didn't study a single course in finance when I had the opportunity to do so. I thought it was sickening. And not that I've changed my mind about that much.
Bengali mind, making money is sickening?
No, it wasn't the making money that was important. I didn't see that as the exciting part, and I still don't, interestingly. I don't think that investing is exciting because the outcome, if it's successful, is making money. I actually think it's more about, figuring it out. Because that's the real challenge. Understanding a business, understanding people, understanding a context in which you invest, and then if you can figure that out broadly, you can get most of the dimensions right, and you make sensible decisions. That's really the exciting thing.
Enjoying the process more than the proceeds.
Far more. It's like golf. When you walk on the greens, the joy is as you walk on the greens, what you see, what you hear, and your mind is totally still. It's true of almost any activity that the ability to still the mind, focus and concentrate is what gives you the maximum joy and the highest output.
In case you have trouble with the proceeds, I'm happy to share it with you.
Mr. Damani, I'm always at your service. Always at your service, sir.
But let's get back. How did you get to this concept? How did you first hear about it? And then how did you start practicing margin of safety?
So I read a book by a guy called John Train.
Money Masters, I think.
Yeah, the Money Masters. This is the old Money Masters, not the second edition. And there I read about a bunch of guys, and I thought many of them were very interesting. There was this guy called Phil Fisher, Buffett was there, then Graham was there. There were a bunch of guys. There's a guy called Robert Wilson, who actually, I still remember, I'll never forget this guy for one thing that he did. But, so I read about these guys, and then I said, from which of these guys do I have the maximum chance of sort of figuring out methods which I can apply? And I felt Buffett was was way beyond me. I couldn't do it. Just too difficult intellectually in terms of developing the right mindset, the hardwiring, and so on. And Fisher was interesting, but I couldn't get some parts of it right. I felt I couldn't sort of make judgments, and I didn't have the patience that he had, So I said, gosh, this Graham guy looks interesting. Let's figure on what he does. Because it can be reduced to numbers, and you buy 15 of them, and some will be wrong, some will be right, and once you make a judgment that it's gone beyond what you think it's worth, you get out, and you have a set of criterion to guide you, which are always accessible, which you can,
Which of course, Graham used to say, the net cash, the nets, if you will. But if you had the numbers, why would you be wrong?
You can be wrong for a number of reasons, because the environment can change, as it has a number of times. And we've seen that in 2008, we saw it in 97, 98. So suddenly when the environment changes, the usual relationships that you expect to find in financial markets break down, and they break down at the worst possible time, when you want them least to break down. That's why it's, I think, important to make sure that you're fairly disciplined. One of the great things about what you just spoke about, this margin of safety, is being disciplined. I think there are three things, three alphabets or three letters that drive the ability to use margin of safety as an important tenet of value investing. Discipline, patience, and judgment. And they're very tough. It's really tough.
Just for the record, in terms of a definition, or how would you explain margin of safety to an 18-year-old student in his first business class?
I think, and this is not a great way to explain it, so I'll be forgiven for this sort of amateurish attempt. But to me, I'd say that, if someone gives you a 1 rupee note and you can buy it for 50 paisa or 40 paisa, and even if the note later on turns out to be made by a counterfeiter, if you buy enough such notes, you probably do well.
Buy cheap.
Buy something that's worth a hell of a lot more at a very, very reasonable price. And once in a while you will buy counterfeit goods.
That's the risk.
It's a reality, I'd say. It happens to me very frequently. I hope it happens less frequently to others. But it happens very frequently with me.
Thanks. I'll come back to you, Sanjoy. Anoop, let me get you in on the conversation. Margin of safety, when did you come across this concept?
I'm a slow learner, so it took me around 12 years or 13 years of investing before I came to the concept. So I have lost money consistently personally during the 90s because I was buying all.
Yeah, Anoop, just put it up. Put it closer to your...
Yeah. So I started my career in I think 90s, early 90s. So it took me around almost 10-11 years to figure out what the concept of margin of safety was. So every bonus that I got, which was rare in the 90s, was spent buying stocks and then selling them at 1/3 the value after 2 years. Unlike Sanjoy, I'm not a fast learner. My great ideal is actually Marwanata Patu, who had a score of 0, 0, 0, 0 and 0 for the first 6 innings that he played, for Sri Lanka.
That's almost beats Ajit Agarkar,
So I think so. What came as a learning was the 2003 market, because that was the first time when you saw that companies were making a very strenuous effort to get rid of all the excesses of the previous boom. They were paying off debt, they had got into telecom or some other venture or something like that, and they were all paying, and they were all, going and selling off these businesses to actually pay off debt. I remember Crompton Greaves was at a dividend yield of almost 10% at that point of time. So I bought that personally, and I was just telling someone today that that's the stock that's given me 30 bagger as such. But that was the time when I figured out, actually some of the mistakes that I had made personally over the last 7-8 years before that. And it just taught you more. So you could buy a Blue Dart at a P of 5 and a dividend yield of almost 6% at that point of time. And you knew that business would not go, bankrupt. And I remember that we had a big presentation made by Raamdeo, and he'd come to our office in 2002, where he showed to us in terms of if you were to look at the dividend yield of stocks was actually more than the G-Sec at some point of time, in terms of the
and tax-free too.
Yeah, tax-free too. So I think that was the time when some concept of safety came into my mind. Earlier on, it was more tip-based, and to me a tip is the opposite of pit. So if you want to give someone a pit, you give him a tip, or you want to give him a tip and he'll fall into a pit. And over a period of 7-8 years, after consistently losing money and then trying to figure out why I've lost all the money that I made, I think in 2002, 2003, it was also then aided by the market conditions, that the stocks were very cheap. You could buy good quality companies for once and not buy really bad quality companies because they were cheap.
Well, Anoop, to do this margin of safety analysis post 2003, did you have a private view of a stock, that what it's valued at and what the market was valuing it? How do you arrive at that margin of safety, the formula you used?
Yeah, so I think at some point of time, it's not something which is very formulaic based, that P of less than 5 or P less than 7 or 8. But one way to look at it was that if it was trading at below its 5-year average of valuation and significantly below that, and it was still making profits, then you knew that you wouldn't go wrong on it. So while you can use a lot of databases to get that, I think so when you do a lot of value picks, I think so the biggest pitfall in India that you get into it is that in terms of earnings in the near term for those companies which are very cheap, tend to be very shaky. And these stocks are cheap for a reason, because they'll have, because the earnings is going to be very shaky in the near term. So that issue you have to first get over your mind, that if you buy a stock based on value, you don't have to look at the quarterly numbers. Because if you look at the quarterly numbers and you get scared by what comes out, then you would buy something at 0.8 time book and you sell at 0.6 time book. So you have to be very clear in that first the stock why you're buying it, and B, get a base valuation in place, and then pray a lot that it doesn't come to that valuation, because then you'll be really scared that if it came down to those levels.
But it's part of that process, matching your intellectual judgment and saying, I think the market is valuing company A at 100 crores, and I think you could sell this company in a rainstorm for 500 crores.
I'm really bad at that. I mean, I can't forecast how big companies can be or how big businesses can be. So for me, if I believe that the next 2 years number are at a level where I'll be very comfortable that those can be achieved by the management. Beyond 2 years to take a call in India.
So yours is an earnings-based model. You're not looking at a market cap model. You're not looking at intrinsic value of the business. I
wouldn't look at saying that I want to buy the largest beer company in India, which is available at $200 million, because in US the largest beer company is at $40 billion. So therefore 200 can become 20 billion or 10 billion based on where a population. I am not into that kind of macro investing. So earnings are what is important. I would look at where it is, what the earnings are, and the next 2 years, 3 years number are the most important for me.
Okay.
If on those estimates they can be achieved, and if the valuations are fairly in sync, and if they're below the 5-year average, then that's even better.
Raamdeo, just to bring you in on the conversation, but to finish off on the point that Anoop was mentioning, I mean, is that the way you look at value, or do you have a different formula for looking at value?
See, for me, first thing is that the difference between value and price. Value is what you get, price is what you pay. So understanding what is value in my mind about the business, and that encompasses everything: quality, growth, longevity, this 200
hidden assets,
all aspects of it. But what's the value of that enterprise in my mind, mathematically? Absolutely proven by the numbers and what is there.
Give me an example from your historical file of something you found a huge discrepancy between the price the market was valuing at something and the value you thought was.
Yeah. So let's look at 1997, Hero Honda. The first stock which kind of really I held on for 13-14 years because I had great faith in the value itself. So we were looking at a business which is, it was clearly a leader in motorcycles.
What was its market cap?
Market cap was about 1,000 crores.
In 97, 98?
97.
Okay.
And it had, after 10 years of struggle, it had just about come out of into profits and dividends. But the Splendor motorcycle was in short supply. There was 3,000-4,000 rupees premium on that, and they couldn't supply enough. And Bajaj Auto, which was a scooter manufacturer, it was struggling to stay in, to save the franchise of the scooter, and motorcycle was very clearly taking over. So I had read a concept of value migration by Adrian Saversky. So I could see that the market is heading from scooter to motorcycle. Clearly I could see that, and I bet my optimism onto this market becoming a hugely motorcycle market, because if you see the characteristic of a motorcycle, you need a large base, it was maintenance free, it was almost 2.5 times more fuel economy, and for rural roads you could only do motorcycles, not scooters. So I could see, and the youth was liking motorcycle rather than
more power.
Yeah. So I said they were producing about 100,000, 120,000 motorcycles at that point.
And there was a shortage.
Yeah, and there was shortage. And if you see the penetration at that point of time, probably the penetration of total two-wheelers in India was not more than, say, 1% of the population. 1.5, 2% of the population. I said,
size of opportunity.
Size of opportunity, massive. And then the competitive structure was, if you don't buy Bajaj, then you have to buy Hero Honda. It was just a two-player market.
Was Bajaj, just sort of curiosity, overvalued at that time by your matrix?
I just didn't like that. I mean, I used to go to Bajaj Auto every year to listen to AGM speech of Mr. Rahul Bajaj, and I used to admire how they used to conduct and everything, but I never bought Bajaj Auto because the Bajaj Auto scooter was a absolutely useless product. I've used it in Raipur. In every 10 kilometers, 20 kilometers, it will conk out. So I was not a great admirer, but it was a premium product. That was the only thing available. So I never got what you call confidence in Bajaj Auto. Though I used to go from here to Pune.
To the AGM.
So this was an opportunity which was godsend. And in 17 years, in next 5 years, all the 100% incremental growth of the industry was picked up by Hero Honda. And from nowhere, it came from behind and became number one by 2002-03. And stock went from 1,000 crores market cap to, I think, 15,000-20,000 crores market cap, and the kind of dividend they give.
Dividend payouts, yes.
Yeah. So we are still doing that wealth creation study. So one of the numbers which came out yesterday, this is 17th study. In all 17 studies, if there is one company which is a wealth creator, it is Hero Honda only. Only Hero Honda, nothing else. I was stunned to see the number yesterday.
That's actually a fabulous call. But
Yeah.
Raamdeo, let me get you back to the start, like I asked the other gentleman. You're a college student, not necessarily exposed, not an international MBA. How does Raamdeo Agrawal come up to understand margin of safety?
So margin of safety, I learned very, very late in the game.
The hard way, or you learned it?
Of course, hard way. I mean, I lost a lot of money, and I didn't make a lot of money. So, this book, Intelligent Investor, was lying in my rack, and I was reading Buffett's in 95, 96, thanks to Sanjoy. He introduced me Warren Buffett, so I became Bhakt of it. I was mad after stock, so I would do anything what Sanjoy would say. So I started going to US, reading all the balance sheets of Berkshire Hathaway. So clearly shifted from a very non-focused portfolio to focused portfolio, from a low quality stocks to high quality stocks. So portfolio started doing reasonably well. But I thought this Intelligent Investor book is useless. It's an old book. Buffett has updated everything, so it must all be there. Then somehow I got my stocks crashed in 2000. The tech stocks, Mastech and all. I mean 30-40% of the portfolios got lost in single stocks. So then I said there must be some problem. Then I thought, let me pick out this book and read it. In 2003, first time I realized you got to buy at right price. And that is margin of safety.
That's the key.
That's the key. So since then, if you see our wealth creation study, we started incorporating the importance of buying at right price, valuation per se. So I think it is 2003, too late in the game, almost like I started buying from 1980. So you can imagine 20, almost 20 years henceforth, I realized margin of safety. Because once you get that, even if you practice or don't practice, you know where you are committing mistake when the results come out.
Correct. Fair. Sanjoy, both these gentlemen...
I must tell you a very interesting incident related to just what Raamdeo said. I find it fascinating. So he read Intelligent Investor, and I had just heard about this guy then called Seth Klarman, who had actually written a book called Margin of Safety, a fascinating book.
You can get for $1,000 in reprint.
Now. But you see, what had happened is in 1992, on one of my visits to the US, I had bought that book for $25 at a shop called Stacy's in San Francisco. And I read it and I was just mesmerized by this book. I said, gosh, this is really the book. I can figure this out. He writes in simple English, and so I came back. And Raamdeo was on to this Intelligent Investor, and that's a great book as well. So I said, we were both going to Omaha that year. So on the flight from Chicago to Omaha, I said, Raamdeo, I've got a real exciting gift for you. Not a gift, a real exciting thing for you to read. So I proudly took out my copy of Margin of Safety, little realizing that this was going to become one of those epic books. And I gave it to Raamdeo. I said, read this. So you have a flap in front of you in the aircraft. So Raamdeo read 30-40 pages, and he put it in that flap in front of the aircraft. And then we got down at Epley Airport. Both of us got down, walked out of the aircraft, and then I told Raamdeo, wo kitab ka hai? Sorry, wo to main chhod diya. So we rushed back to the aircraft, and our margin of safety had disappeared.
Oops.
And it happens very often in real life that way. You have a great start, you identify a margin of safety, and the ground moves below your feet. Because so it happened to us in real life.
Because book value sometimes is not a margin of safety. If you're buying it below book, you think you have a margin of safety. But
and this was it. This was book value. Literally. This was book value.
Literally, you're right, absolutely. But Sanjay, let me now pick your brain about... go through historical memory and tell me a stock where practice and theory collided and you got a stock at the right margin of safety and the kind of returns it gave you in your portfolio. So give us an illustration of that.
There aren't many. This is a really tough one. But this one was really, it always sticks in my mind because of so many interesting things about it. And I'm amazed at how, times change. So you were speaking about, Raamdeo said really it's the arbitrage between value, which means understanding the business, figuring out what it's worth, and there are many elements to figuring out what it's worth and what you pay for it. And once that gap is significant, it's the same point that Anoop made. In different ways, I think everyone makes that point. I made it in a crude way, they made it in a more sophisticated way. But basically, if you think that, it's worth 1 rupee, your understanding of the business and what it's worth, and it's trading for 50 paisa, and right there you have this
Buy by the truckload. But give me an example.
So I'll tell you, the one I came to. So, now the interesting thing, and very few people sort of seem to get this because they become deluged by stereotypes, is very often, if you figure out that a business is going to grow at a predictable rate, it doesn't have to be very high, but it is going to grow at a predictable rate for a long period of time, and it's available at a reasonable price, then the fact that you've figured out that it's going to grow for a long period of time at a reasonably high rate, Hero Honda, the growth is the margin of safety.
Correct.
It's amazing. There are some businesses where looking at the environment and knowing what adjustments to make as the environment provides you the opportunity, because there's high level of regulation, because there's government involvement and so on and so forth, or the consumption pattern may change, good management can provide you the margin of safety. Not easily understood. Because proactive management, again, Raamdeo has this wonderful ability to do all these things, because clearly Bijmohan Munjal was at the cusp of change. The scooter market was completely sort of ravaged by two-wheelers. The ratio between scooters and two-wheelers now has changed. It was, I think, 3 to 1 when he bought it. Scooters were 3, two-wheelers were 1. Today it must be 10 motorcycles or 12 motorcycles for every scooter. That is about the most dramatic thing you can hope to see in 17 years. And I must say, the one great thing about this whole value investing, the best way you can do value investing is by meeting a master. So I'm privileged to have met the 3 of you, because many of my greatest gains have come from following your footsteps. But okay, yeah, to come back. So there was this talk called Container Corporation. So I was amazed, because this was India's largest sort of logistics company, not integrated, but largest logistics company, and it had a relationship with Indian Railways. It was actually it was a spin-off from Indian Railways. The guys came from Indian Railways into the management of Concourse, and they used to get preferential treatment even in the tariffs.
Correct.
For the wagons and so on. And it was a monopoly. There was no one else. In 2000, when I joined HDFC, this company had no competition. There were some small roadway companies and so on, but
no one had the tracts of land.
No one had that.
Rolling stock they had.
Zero. The warehouses and so on. So I said, gosh, this is really worth looking at. And the reason it came up was I used to do a filter to look at companies which had price to cash flow multiples of less than 3. And lo and behold, Container Corporation had price to cash flow of less than 3. I said, this is a miracle. So I said, maybe this is a fluke, because last year there was some adjustment in cash flow. So let's go back. The previous year also, continuously for 5-6 years, huge amount of cash flow. Recently listed I think 2 years ago, listed in 99, on 2000, one of the first PSU divestments. And clearly a business dependent on trade. The essence of Container Corporation was trade. Exports, imports. It works both ways. And the company was not keen to meet analysts. So very few people knew what this company was about, which is a huge advantage. Because if you understand the business, and very few other people do, that leads to the discrepancy between price and value.
Yeah.
And that's very important. Getting in early can also confer a margin of safety if you understood it right. So I rolled up to Delhi, I met, Ruma Mukherjee, I met various people.
What was the market cap when you were looking at it?
When I bought Container Corporation, the market cap...
I know the price was about 140 maybe.
I'll tell you. It was under 500 crores. It was 480, 490 crores.
Earning about, what, 150 crores cash
No.
flow?
At that time it was earning 125, 130 crores.
Yeah.
So I diddled for a while. I did this classical investigate first, invest later, which destroyed me because market cap went up while I was doing my investigation. I changed that idea later on. I used to invest first, then investigate. That's my motto now. I learned from that mistake. So I went there and they told me a lot of interesting things. Why it's so difficult for someone else to get in.
That's the moat.
Yeah. So then I said, gosh, this fits in with this Buffett idea. And then I said, okay, what happens if Indian Railways decides tomorrow not to give you this preferential treatment? So you'll have to have price increases. Can customers, will they accept this? They said,
still
yeah.
cheaper than road.
Much cheaper. At that time, the gap was massive. So I said, great. Then I said, how long is the chairman going to be in place? Because there's a very smart chairman then, a guy called Kohli. So he said, 5 more years I've got. And every chairman has to be there for 5 years, regardless. Up to 62. So I said, this is wonderful, this is not like a PSU. And I said, do you have any sort of, issues which can, like do you have any commitments, liabilities which are not stated but which can crop up in terms of payments to railways? None whatsoever. So I came back and I rang up the brokers and I said, I want to buy Container Corporation. And they said, sir,
ये तो PSU है.
ये इसका share trade नहीं होता sir. ये माल नहीं मिलेगा.
That was music to your ears, right? You wanted to buy it.
They told me that only one person who owns Container Corporation. So we have to persuade 2 people. We have to persuade them to sell. Sir, LIC के पास है और Morgan Stanley के पास है. तो मैं बोला अभी आप पता करो कौन बेचेगा, किसी को समझाओ कि मतलब उनको अगर बेचने की इच्छा है तो आप खरीदेंगे. So the guy comes back to me and says you have to pay $10 more. So I said, you have to pay